So now let's look at all these various different decision metrics that help us make a decision on whether or not to go ahead with the project or not. But the best way, now you might look at these averages and say, hey, gross annual rent, you've got an average, great, big deal. What happens is it actually makes a big difference when you are comparing two different properties and comparing what their averages are. So I would say, let's say you had you had done another feasibility or another smart real estate investment analysis on another property, and you wanted to compare both of them. I would open that side by side, and then slowly comb over each of these different averages and compare them, what they are coming out to be. Now you might even do a save as new, for example. In that scenario, you would click on save as new, go and change a few different assumptions because what you are making, and then keep them side by side to see what they look like in both different scenarios. That's why all that, it makes it very easy to create several copies of the same feasibility just by changing a few things, and you know what they are, so that you can then compare all these various different decision metrics with each other to figure out which one is the best option for you to invest in. So now let's look at these averages. You've got gross annual rent. It gives you an average of what everything is going to be. Your other income, we didn't put any value here under other income, which was here. That's why it shows zero. Effective gross income, operating expenses, net operating income, and so on. Then you've got your finance assumptions that we have made, which is lender's yield. So this is what your lender is actually making when they are lending the money to you. So the lender's making 6.9 on it. So the margin is very thin for them. So amortization period is 316 months. Loan in terms is about 120 in months, which is the loan term. And so you've got, this is in months because we're doing a 10-year 10-year analysis on this. Interest only period in months, amortization, you've got debt, that's your maximum debt, total deposit or down payment, annual interest on mortgage, that is what it is going to be. Your monthly mortgage payment is going to be that much. Loan payoff amount is going to be 918. Your ratios, for example, your debt coverage ratio, your average interest coverage ratio, your break-even ratio, your gross rental yield, net rental yield, average gross rent multiplier, net income multiplier, operating expense ratio. These are all ratios that tell you different things about it. And with the main training, I will slowly introduce videos introducing these concepts later on down the track. But your main decision metrics are your IRR that you're going to make 17% on it, cash on cash return, your present value of this property, your net present value. All this is based on your discount rate that you've just selected here, your profitability index, your equity multiple, your gain on sale when you actually sell the property. So all these things are just summarized here, so you can quickly, instead of scrolling back and forth between what everything is at, you can quickly see that. But you can by all means look at all the different cash flows and what they look like and the impact that they have. So your net operating income is going to be about 92. Then you've got capital improvements, you've got interest calculations, you've got taxable income, you've got levered cash flow before and after tax, your discounted cash flow, your net present value. All these things are available here, what they see. And for every year, you can actually look at what they are. Again, comparing two different ones together is where you will get the most benefit of all these different metrics. Then you got your capitalization rate, which is actual, your exit value cap rate. So based on that, what that value is coming out to be, your rental yield, your gross rental yield, your net rental yield, your gross rent multiplier, your net income multiplier, growth on equity return, what is your growth on the equity, and what is the return that it's giving you. So it starts really giving you that return after the fourth year. That's when it starts going up. that's when you start building up equity, because first 3 years you're not adding any equity in it, because we had first 3 years of interest only period. So that's what this does. It measures the return that you're getting on the equity that is getting accumulated into the property. Then you've got rental yields, market value, gross rent multiplier, growth on equity return, then your loan payoff balance, what it is going to look like. But the main thing that you would want to do is cash flow from operations, debt service, and I'll have a separate video explaining what each section is, but I'm just giving you an overview of what all is included in here. This is all related to the section here, where we said we make 180,000. And when we make 180,000, we go and match. Okay, this is where we start. We escalated by 3%. We have taxable deductions. We didn't enter any value for our taxable deductions. If you have, for example, let's say 2,500, if I was to add, then it will add those deductions in there and then start escalating them at 2.5% based on our assumption that we had made. So those values will start coming up here. Then you got your individual income, your rental income, your net taxable income, your tax payable on that, your effective tax rate based on everything that you enter here based on this table. So all those things will start making help you make a decision of whether or not this is going to be positive or negative for me. Then you got your repayments and net cash position. This takes into account the income generated from the property and your taxable income. So it combines both of them and then gives you a snapshot of what it would look like for you, so that this is your net cash position. And then you take out your household expenses from it, and then your net disposable cash flow is calculated of what is left over to you after you've done your calculation. Now we have this thing called IRR matrix. It will automatically expand to the number of years you do. So let's say we do a 60-year analysis. If I try and put 65 here or anything over that, it won't let me because the maximum value is 60. And once you put 60, you'll see that this thing will expand all the way through to 60 years. And this entire IRR matrix is also expand, showing you that every year, what is the internal rate of return if you sell the property after a certain period of time. So you'll see that it starts decreasing because the longer you are holding it, because what is happening is IRR is based on money that went in and the money that is going in over a period of time, but it is calculated based on when the money comes back. The sooner the money is coming back, the higher the internal rate of return is going to be, because you don't have to wait that long. So if you have to wait 60 years to get it, you're only going to make about 11.82 in the long run based on the assumptions that you have just made. So this, if I reduce it to 50 thing, you'll see that this IRR metrics goes all the way to 60 years to calculate your value of what the property would give you in terms of your internal rate of return when you dispose the property off. So let's change it back to 15 years, for example. Let's go save and refresh. And you will see that this will now change. And then you can see that, okay, I want to make 24 or 30%. Then it means the 7th year is the best year for me to get rid of, so long as I can get this value. So when you're hitting the 7th year and your property value is close to this, that's when you would want to make a decision to sell it, because that's the point where you will make the most return. You can sell it after 5 years, and if you sell it really quick and the value has already gone up and caught up to that point, then that makes sense. Now, another thing that we didn't discuss earlier, because right now we are doing everything based on the growth rate. Let's say we were to do the calculation based on NOI cap rate, and our exit cap rate is about 7%. So if I go save and refresh now, this will change the future value that I'm going to use to sell the property at the end of it. Let's make it 10 so that it's easier and we can see that in one screen without me minimizing, zooming out or zooming in into this. So now let's go back here and you will see that towards the, so now these values start changing based on the new sale value that we have calculated at the end. So this is what it is. So in the end, this is your levered cash flow, this is your normal cash flow, this is your exit sale value calculation based on NOI cap. Sale proceeds at exit. That means at the end in the 10th year, you will sell it for 1.5. Your sale closing costs at exit are going to be that much based on the percentage of commission that you might have allowed for. And then you've got your gain on sale, what you made on the sale after paying out your debt obligations. Then you've got your cash flow after debt service, what you've got left, and then profit before tax, discounted cash flow. And that gives you a good idea of what the property would end up giving you in terms of return. Now, there are two different IRRs. The first IRR is what you put in and what you made towards the end. It is based on your pure equity contributions, the equity that you put into the project when you bought the property, equity that you have been paying into with principal payments that you have been making all along these 10 years. So based on that, you ended up with this, and you eventually, the gain on sale that you had, or the money that came back to you after paying your debt obligations, based on that, you made 8.6 IRR. Now, when you go down and you look at the IRR metrics, this basically looks at the entire IRR table. That is the money that you paid in and what did you sell the property for at the end of the 10-year period. So these two IRRs are different because this is the metric that shows you that if you buy it at this point and sell it at this point, when is the best time that when will you make the most money? I mean, the quicker you sell, the more value you will make, but chances are that your property may not reach that sale value as quicker based on your assumptions, and that is why this whole IRR table is there. However, if you look at just the money that you put in and what you've gotten back, based on that, your internal rate of return is 8.6% over a 10-year period. So these are the two differences. Then you have to make a decision as to whether you go with this or you go with another property that you can compare their IRRs together.